Canada carries a AAA credit rating, the gold standard of fiscal trust. But by 2026, federal gross debt is projected to hit $2.35 trillion. That's $56,000 for every Canadian alive, with interest payments alone devouring $54 billion a year, 10 cents of every budget dollar spent servicing money already gone. And that's only the government's side of the ledger. Canadian households owe another $3.2 trillion, and 60% of those mortgages are about to renew at rates their holders have never faced. Behind the AAA facade, the math has finally hit zero. The numbers on Canada's balance sheet have never been this stark. As of 2026, the federal government's gross debt is projected at $2.35 trillion. That is $56,432 for every single Canadian, children, seniors, and new arrivals, each carrying a personal share of the national tab higher than at any point in modern history, except the pandemic peak. The math is not just abstract, it is a ledger entry that sits over every household, every business, every public service. Gross debt means the total amount the federal government owes to lenders before subtracting any financial assets it holds. Net debt, which deducts those assets, still stands at $1.236 trillion. But when it comes to the cost of keeping the country running, it is the gross number that matters most. That is the figure bond markets watch, and the one that sets the pace for interest payments. Those payments now consume about $53.7 billion a year, roughly 10.7% of all federal spending. For every dollar Ottawa budgets, more than 10 cents goes to servicing money already spent, not to schools, hospitals, or infrastructure. In practical terms, interest costs now rival the combined budgets of national defense and Indigenous services. Canada's debt-to-GDP ratio, a key test of fiscal health, sits at 101%. In other words, the country owes more at the federal level than its entire economy produces in a year. That is a threshold usually reserved for crisis economies, not for a country still stamped with a AAA credit rating. The numbers are not standing still. Per person, federal debt has jumped by over $1,700 in just the past year, and the trend line points only upward. The Department of Finance warns that as deficits persist and economic growth slows, the share of the budget eaten up by interest will keep rising, squeezing out room for new programs or tax relief. Bank of Canada Governor Tiff Macklem has publicly cited these liabilities as a structural constraint. He warned that without productivity gains, the debt-to-GDP ratio will remain on an upward trajectory. The warning is clear. The math has finally hit zero, and the cost of carrying the old debt is now shaping every future choice. This is the macro audit, a trillion-dollar burden that defines the horizon for every Canadian and sets the stage for the deeper household pressures still to come. Interest has become Canada's most expensive line item that nobody voted for. Each year, about $53.7 billion leaves the federal budget simply to keep the debt afloat. That is 10.7% of every tax dollar, a share that now rivals what Ottawa spends on national defense and Indigenous services combined. For every new school, hospital, or transit project that gets proposed, there is already a silent drain, more than $1 in $10, committed to lenders, not to people or programs. This is the cost of carrying yesterday's decisions forward, with the federal gross debt set to reach $2.35 trillion by 2026. The interest bill alone has become a force that shapes what government can and cannot do. The Department of Finance warns that as deficits linger and growth slows, the share of the budget eaten up by interest is only going to rise. Each uptick in rates, each year of rolling over old loans, tightens the fiscal leash. The math is simple, but relentless. The more spent on interest, the less room there is for new ideas, tax relief, or even keeping up with inflation in core services. Yet through it all, Canada's credit rating remains AAA. On paper, the country is still seen as a safe bet, a model of fiscal prudence. But that reputation is at odds with the shrinking space left for real policy choices. Bond markets may still trust Ottawa, but the budget's flexibility is being quietly eroded by the sheer weight of servicing old debt, the squeeze is not just a federal problem. While Ottawa's debt to GDP ratio has broken the 100% barrier, household debt is even more leveraged. Household debt now equals 101% of GDP, and the private sector's burden is set to become the next front in the debt dilemma. The federal government's narrowing options mirror what is happening in living rooms across the country, where rising interest payments are also crowding out everyday spending. The credibility paradox grows. Canada's stability is being bought at the price of ever-diminishing room to maneuver, both for the government and for families. Canada's household debt now stands at $3.2 trillion, a number that, on its own, would rank among the world's largest economies. For every dollar of disposable income, the average Canadian owes $1.77. This debt-to-income ratio of 177% is not just a statistic. It means that for many families, nearly twice as much is owed as is earned after taxes. The result is a fragile personal balance sheet, where even a small change in interest rates or income can tip the scales from manageable to unmanageable. Mortgage debt makes up the bulk of this liability. 3 out of every 4 borrowed dollars are tied to the family home, but the structure of these loans has shifted in ways that add new risk. One of the most concerning features is the rise of negative amortization mortgages. In these arrangements, the monthly payment does not even cover the interest that is piling up. Instead of shrinking, the principal balance actually grows over time, even as borrowers keep paying. At its peak in 2023, about 7% of all mortgages, roughly $30 billion, were negative amortization. By 2026, that share has fallen to just under 3%, but the absolute exposure remains significant, especially in markets like Toronto and Vancouver, where home prices and loan sizes are highest. This kind of loan structure is not just a technicality. For households already stretched thin, it means the mountain of debt gets steeper with every passing month, and with 60% of all mortgages set to renew in 2025 and 2026, many families will face a sudden recalculation. Payment shocks from 15 to 40% are not outliers. They are the new normal for borrowers who locked in ultra-low rates during the pandemic. The Bank of Canada's policy rate, now paused at 2.25%, sets a floor under these recalculations, but offers little relief as the renewal wave approaches. Beata Caranci, chief economist at TD Bank, points out that nearly half of renewing households have loan-to-value ratios above 80%. These are families with little equity cushion, facing higher payments, and shrinking room to maneuver. The numbers reveal a zombie household effect, where homes are treated like ATMs and debt is mistaken for wealth. Even before the renewal cliff, the system is showing signs of strain. Negative amortization is a warning signal. It tells us that the math is already breaking down for a growing share of Canadians. The next section will examine what happens when these fragile balances are put to the test. 60% of Canadian mortgages, millions of households, are set to renew in 2025 and 2026. For many, this will not be a routine renewal, but a financial shock. The Bank of Canada estimates that even if the policy rate holds at 2.25%, fixed-rate borrowers will see monthly payments climb 8 to 12% in 2025, with another 4 to 9% increase in 2026. These are averages. For those who locked in ultra-low rates during the pandemic, the jump is far steeper. Payment hikes of 15%, 20%, or even 40% are not rare, but a reality for nearly a quarter of renewing borrowers. The impact is not spread evenly. In Vancouver and Toronto, where home prices and mortgages are highest, over a third of borrowers will face payment increases of at least 20%. In Calgary and Winnipeg, almost 1 in 5 will see a 10% hike. Atlantic Canada's numbers are lower, but the risk is magnified by limited household liquidity and a higher share of retirees living on fixed incomes. Across the country, the most vulnerable are younger families, recent immigrants, and self-employed workers, groups already stretched thin by high debt and low cash reserves. Bank of Canada analysis shows 23% of renewals fall into the high shock category, with payment jumps above 20%. Another 22% will see increases between 10 and 20%. For these households, the math is unforgiving. A family with a $2,500 monthly payment could soon owe $3,000 or more, with no matching rise in income. The result is a direct hit to cash flow, forcing cutbacks in spending, savings, and essentials like food or childcare. Beata Karanchi, chief economist at TD Bank, notes that nearly half of renewing households have loan-to-value ratios above 80%. These are families with little equity cushion, facing higher payments and shrinking room to maneuver. Canada's economy has not just slowed, it has stalled. Output per worker now trails the United States by a full 28%, a gap that has only widened over the past decade. According to the latest OECD and IMF tables, Canadian labor productivity sits at about 3/4 the level south of the border. The story is the same for real GDP per capita. In 2025, Canadians produced the equivalent of 72 cents for every dollar generated by an American. That gap, once a source of national anxiety, is now structural. Since 2019, real GDP per capita in Canada has actually declined, even as population growth has masked the slippage in headline numbers. What does this mean for the Diet dilemma? Without productivity growth, every dollar of new borrowing weighs more heavily on the economy. Debt to GDP ratios worsen not just because of more borrowing, but because the denominator, real output, fails to keep pace. The Department of Finance and the Bank of Canada have both warned that the math does not work in a low-growth world. Interest payments keep rising, but the ability to pay them off erodes year by year. Economist David Rosenberg describes the situation bluntly, saying Canada's economy is on life support. In early 2026, he pointed to a negative 0.6% annualized GDP growth rate, a productivity growth rate of negative 0.2%, and an unemployment rate edging towards 7%. We are not generating enough output to service the debt load, Rosenberg said. The numbers confirm it. With a persistent 28% productivity gap and a shrinking GDP per capita, the country's fiscal engine is sputtering just when it needs to accelerate. The next chapter in the story asks where all the capital has gone and why it is not fueling the sectors that could close the gap. Over the past 15 years, Canada's economic engine has been quietly redirected. Investment in the extractive industries, oil, gas, and mining, has fallen by about 15% since 2010, dropping from $49 billion to just $41 billion. These sectors once drove exports, created high-value jobs, and filled government coffers with tax revenue. Now that capital is pouring into residential real estate instead. The reason is clear in the numbers. The total value of Canadian housing now equals 488% of median disposable income. In plain terms, the average household would need nearly 5 years of after-tax earnings just to buy the median home. This is not a natural evolution. Tax incentives, mortgage guarantees, and policies like the Home Buyers Plan have steered both household savings and institutional money away from industries that build future productivity and into the promise of ever-rising home prices. The result is a kind of Dutch disease, not caused by oil, but by condos and detached homes. The housing market has absorbed the lion's share of new investment, leaving less capital for sectors that could close the 28% productivity gap with the United States. The costs are not just theoretical. With housing values so inflated, mortgages now swallow up to 60% of take-home pay in Canada's most expensive cities. The debt-to-income ratio stands at 177%, and the country's total household debt has hit $3.2 trillion, numbers that rival the size of the entire economy. For many, homes have become ATMs, and debt is mistaken for wealth, but the cash out comes at a price. The more capital that chases real estate, the less remains for innovation, manufacturing, or resource development. As investment drains from productive sectors, the country's fiscal and social foundations weaken, setting up the human toll that will soon come into sharper focus. A generation of ghosts is taking shape across Canada, not in haunted houses, but in food bank lines, crowded shelters, and classrooms where hope is rationed alongside breakfast. In 2025 and 2026, food banks are bracing for 2.2 million visits, an all-time high in a country that once prided itself on a strong social safety net. The faces in these lines have changed. 1 in 5 is now a member of the working poor, people with jobs who simply cannot make the math work when mortgages absorb 60% of their take-home pay and groceries outpace wage growth by several dollars an hour. Children make up over a third of food bank users, their futures mortgaged by decisions made far above their heads. Richard Matern, director at Food Banks Canada, has tracked the transformation. "We're seeing more full-time workers than ever before," he says, and the fastest growing group is families with young kids. The numbers are relentless. A $7 an hour gap separates what it costs to live from what the average job pays. 62% of people expect poverty to worsen, and a third of food bank clients are under the age of 18. For many, the dream of home ownership has faded into a kind of cost of living exile, a reality where houses are used like ATMs, debt is mistaken for wealth, and the math has finally hit zero. The mood is shifting. Neighborhoods that once felt immune, suburbs, commuter towns, even affluent enclaves, are now seeing a surge in food insecurity and quiet desperation. The brain drain is accelerating, with professionals and recent graduates leaving for places where the numbers add up, and the future does not look so bleak. In the shadows of record debt and shrinking opportunity, the Canadian dream is hollowing out, replaced by a daily struggle to keep the fridge full and the lights on. Arithmetic has become destiny. By 2026, the federal debt burden stands at $2.35 trillion, $98,491 for every Canadian. This is not just a national record, but a generational high watermark, outstripped only by the emergency borrowing during the pandemic. The average household now carries a per capita government debt that would have seemed unthinkable even a decade ago, but the numbers do not stop at the public ledger. Mortgages now swallow up to 60% of take-home pay in the country's most expensive cities. For every dollar of disposable income, Canadians owe $1.77, pushing the debt-to-income ratio to 177%. The cost of keeping a roof overhead has transformed homes into ATMs, with debt treated as wealth, and the math finally hitting zero. The cash flow squeeze is relentless, as 60% of mortgages come up for renewal in 2025 and 2026. Families face payment shocks ranging from 15 to 40%. These are not isolated cases. They are the new normal for millions. The Bank of Canada policy rate, holding at 2.25%, offers little comfort as borrowers brace for the recalculation. Across the country, the mood has shifted from worry to dread. A recent poll finds that 71% of Canadians believe the cost of living will continue to worsen. Expectations of poverty and inequality have reached levels not seen in decades. The so-called Canadian dream, once defined by home ownership and upward mobility, now feels hollowed out, replaced by what some call a cost of living exile. The verdict is in. After years of using houses like ATMs and treating debt as wealth, the country has reached its limit. The numbers on the balance sheet are no longer just statistics. They are a final judgment on a system that has run out of room, out of time, and out of excuses. Today, for every dollar of disposable income, Canadians owe $1.77. Household debt stands at $3.2 trillion, and federal liabilities are nearing $2.35 trillion, or $56,432 each. 60% of mortgages face renewal, and half of take-home pay vanishes to housing. The math has finally hit zero. The Canadian dream is not just hollowed out, it is now collateral. What future do we build when debt outpaces hope? Share your perspective below.